Alrighty, we're doing a fintech video today. How's it going, everyone? My name is Josh Mountain. If you don't know me, I'm a software engineer, entrepreneur, and YouTuber. And today I'm going to be covering everything you need to know, the complete comprehensive guide on how to retire wealthy using Robo-Investors. In this, I'm going to break down everything. Normally, I try to condense these videos down a little bit, try and bring it, make it more compact. But for this video, we're going to be taking a little bit different of an approach. I'm going to give you literally all the information, everything you need to know so that you can understand if Robo-Investing is the right decision for you. Starting from the top, if you don't know anything about investing and you don't know anything about Robo-Investing, this is going to be the place where you'd like to start. Because today, we're going to cover it all. So let me kick things off with the most basic of it. Investing. What the heck is it? And what makes robo-investing any different? To put it as simply as I can, investing is spending money to buy a stock in a company. I'm going to speed through the stock section here really quickly just so that we can get to the robo-investing sooner. But basically, a stock is owning a portion of a company. You pay money at what the current market rate for that stock is. And if the value of the company that you purchase, again, buying a stock means that you're buying a small percentage, a small bit of ownership in a company. And if the valuation of that company goes up, your stock is worth more. If the valuation of that company goes down, well, your stock's going to be worth less. Investing in stocks can be a great way to protect yourself against inflation because owning pieces of companies is going to allow you to actually move and grow your money over time. The best way to grow your wealth over the long term is by investing in a wide variety of companies, specifically ones that are in large things called ETFs or index funds. It's basically, instead of owning one whole of a particular stock, you're owning little tiny pieces of the top stocks on the market. With the idea here being that if you own a small portion of the top stocks in the market, let's jump forward to 40 years from now, those stocks are going to be worth a lot more than what you paid for them now, allowing you to retire wealthy. But that's enough about the stock portion of it. I'm sure you can go find another video on just the basics of investing if you want to go there. But today we're talking specifically about robo-investing, the idea of using algorithms and predictable trading patterns to actually understand how to make the right investments, and automated platforms that do all the work for you, taking all the guesswork out of investing, and the strategies that you can use to actually employ in your Wealthsimple or Wealthfront or Questrade or Robinhood, whatever it actually happens to be for the platform that you're using, to invest money accurately into what you actually want for your long-term goals in order to retire wealthy. The idea with robo-investing is that there is very little human interaction when it comes to actually making these stock purchases. You have an automated portfolio setup, you just answer a few questions and you're good to go. And by doing this, the company that you're actually going to be investing, specifically with a robo-investor, is able to accurately assess the risk and understanding your time frame to better match your investment requirements. By doing this, they can use their algorithms and data analytics to more accurately get higher returns for you over whatever time frame you are choosing. Now, when it comes to any form of investing, investing for the long term, making sure that you're putting money consistently into the stock market and not sitting there and looking at the ticker price every single day is the best way to grow your wealth and become wealthy. And robo-investing is no different. Just because algorithms are doing the investing for you doesn't mean that there aren't teams of financial experts behind it making sure that those algorithms are performing properly. Obviously, companies like investment firms wouldn't survive very long if they were consistently losing people money over the long term. Losing it over the short term, yeah, we could see that. But over the long term, the idea here is that you're going to be continuing to invest your money over the long term to take advantage of one of the magics of the world, something called compound interest. And again, because this is a robo-investing video and I'm going to focus more specifically on the topic of actually robo-investing, I'll be brief about compound interest. Compound interest is the essential idea that your interest is making interest. Say today you put $1 in, and then, a year from now that becomes $2. A year from then it becomes $4, and then a year from then it becomes $8, and then $16, and continues to double. It will compound, and the interest that you're earning from those stocks is going to continue to grow over time, massively snowballing your portfolio. The way it works is essentially the more money you put in over a longer period of time, the faster and bigger the snowball becomes, eventually getting to the point where you could live entirely off of the amount that your investments are making for you, which is the dream. There are tons of people and communities all over the world that try and take advantage of this through something called the Financial Independence Retire Early Movement, or FIRE, which is essentially just investing as much money as you physically can at a young age so that it snowballs as fast as it can, as soon as it can, so that you can retire early by taking advantage of that compound interest and stacking a massive portfolio up at a young age. Now, robo-advisors are not really something new. They've been around more recently in the past 5 or 10 years, with more people being able to access things through like their smartphone. But in fact, robo-advisors have been around since really the early 2000s, with Betterment and Wealthfront leading the way. These were more attractive than regular institutional investing because they offered lower fees and made things more manageable. And because you weren't having to talk to a person all the time, it made it a lot easier to actually go and understand how all your investments were working. Although that might sound a bit paradoxical, once smartphones were invented and we could actually get our investment apps on our phone, that was it for human interaction when it came to investing for people who use Robo-Advisors. The ability to simply look at your investment portfolio on your phone and make purchases directly from the app that you're working with, well, it was so much easier than calling up your financial advisor and saying, hey, I want to purchase a stock at this price, and then having that conversation. The convenience that Robo-Investing enabled made it so much easier for millions of people to continue having their assets be invested automatically for them using these algorithms. The best results you're going to get from investing is when you do it over a long-term period. And with Robo-Investing making it so easy to actually get your automation set up and understanding how much money, is getting invested into your accounts and what your accounts are going to look like somewhere down the line, most robo-advising platforms actually give you a range of where they estimate your actual portfolio is going to be at come that time frame. There are tons of benefits to automated investing through robo-advisors, making it so that you can trade your stocks just by having an internet connection. You save the time by actually not having to talk to a financial advisor every single time. It removes the emotion out of investing, which I will get to in a little bit here, but by making it easy that you can just click a few buttons to make your trades or set it up altogether so that you don't even need to open the app. And finally, making sure that your investment portfolio is going to be decided by algorithms using quick and smart decision making. Robo-advisors analyze market trends, economic data, and user inputs to make smart, efficient decisions about your portfolio. Robo-advisors democratize investing by making it super low barrier to entry for people who are new to investing. For example, if you wanted to retire with over $1 million in the bank, all you would have to do is calculate how much you need to invest monthly in order to retire at the age you want with that $1 million. All you do is set up your automations, turn off the app, come back to it after, say, 20, 30, or 40 years, and boom, there you go. It's a foolproof strategy that can only be foiled with your own intervention. The fact is, there are tons of automated investing platforms out there that use robo-advising algorithms. Things like Wealthsimple, Robinhood, Questrade, etc. The list goes on and on. Just pick your favorite. But I sense a bit of skepticism from you. I hear you asking yourself the simple question, well, Josh, if it's that simple, if somebody could just set up automated money to come out of their bank account and get invested for a period of 20, 30, 40 years and have $1 million in the bank, why doesn't everyone do it? And that's where the catch of investing comes in. The main caveat, the one thing that is going to hold you back from retiring wealthy, not even just through robo-advising platforms, but through any sort of investment, the only thing that's going to hold you back is you. Let me paint you a picture real quick. Think about this. How many times have you had that conversation where you said, oh man, if only I had invested $1,000 into Bitcoin back in like 2007, 2008, if I had invested $1,000 or $5,000 or even $10,000, I would have hundreds of millions of dollars. Oh, if only I had done that. Well, think about this. Why would anyone in 2007, 2008, 2009, why would anyone in their right mind invest $10,000 into Bitcoin? That's one of the stupidest things you could have done at the time. Sure, we have the benefit of hindsight. We can say, oh, hey, obviously if we had invested that amount, if we had invested, $10,000 into GameStop in 2020 before that big explosion happened with Wall Street bets and that whole fiasco. Anyway, I'm getting off track. If we had invested then when the stock price was $4 and then sold when it was at 400, we would have made a ton of money. But that's just it. You've got the benefit of hindsight holding you back. And the interesting thing about investing in the present is you don't have hindsight on the future, you only have hindsight on the past. That's how hindsight works. So when I'm investing, I make decisions that I think, what would my future self say to me if I could talk to my future self right now? What would he say to me? What would he say? He said, oh man, I wish I could have just invested in this in 2024. If only I had invested in this industry in 2024 or this particular stock. What do I imagine those things that he is saying are? Even if they aren't the popular stocks now. Because the fastest way to kill the wealth that you're building through compound interest is to be an emotional investor. To let not logic, not reason, not rational decision making, but emotion guide your decision making. Because it's very easy for someone to say, oh, all you have to do is invest in the stock market and 20, 30 years down the line, you will be completely financially independent. But it is so much harder for somebody to say that and then simultaneously not look at their portfolio and not see how it's doing, especially when times are bad. One of the worst things about emotional investors, specifically on platforms like Robinhood or Wealthsimple or any of these robot platforms, is that they can see their portfolio in real time. They don't have to wait until their stockbroker is available for them to take a phone call to actually figure out how their portfolio is doing. They know the second that a stock or an industry trend starts to go down that their portfolio is tanking in value. And so many times, emotional investors lose the rationality and take on a gambler's mentality and go, I have to sell everything, I have to maintain my... They don't understand that over the long-term period, the stock market has continuously gone up. And yes, people say things like, oh, well, what about 2008? If most of the people who had invested assets in 2008 simply held onto those assets, they would have made over 400% on their money. But it was the panic... 2008 is a totally different thing, but you get my point here. The panic selling is what kills many investors' wealth. And the difference is on robo platforms, your financial advisor isn't going to be doing that. It's going to be you doing that. Emotional investing leads to buying high and selling low. Because when people are talking about the stock market, people are saying, oh my gosh, look at how much money these people are making. Look at this stock that jumped 1,000% in the past day. That's when we get in the gambler's mindset. We think, oh my gosh, fear of missing out. I'm going to miss out on this amazing opportunity. I have to get in now. When people are talking about stocks and they're really excited about stocks and they're adopting that we're all going to be rich mentality, that is exactly when you should not be investing more in stocks. At any given time, you should be investing a healthy amount on a regular basis. It should be very consistent. And I'm going to give you a little bit of a cheat sheet on how to know when you should be investing more in the stock market and when you should be investing less in the stock market. And it's called the Fear to Greed Index. Now, for those of you who don't know what Berkshire Hathaway is or who Warren Buffett is, let me fill you in on some key details. Warren Buffett's investing strategy is very simple. He is over 90 years old, and he has been investing for a long, long time. He was able to take advantage of that thing called compound interest by simply buying and holding over a very long period of time. And as a result of that, his holdings company, Berkshire Hathaway, which holds a lot of assets under management, basically a lot of money under that company, they've been holding it for a long, long time. And he has a very simple strategy when it comes to getting rich. Be fearful when others are greedy, and be greedy when others are fearful. And let me introduce to you the Fear to Greed Index. Now, this is the Fear to Greed Index. It tells you a couple things. First of all, on the far left, you can see there it says extreme fear. Then we have fear, neutral, where we are currently at, greed, and extreme greed. And it's very simple to understand. What emotion is driving the market right now? Now, for you, when it comes to picking out your individual stock picks, you don't have to really worry about this. But how does the Fear and Greed Index relate to you? I mean, after all, if you're using a Robo-Advisor, you're not being the one who's actually picking the stocks. So what does it matter to you what emotion's driving the market? Well, it's going to be much better for you, and you're going to retire much more wealthy if you understand the basics of how this works and actually understand when you need to invest more and when you need to invest less. At the end of the day, retiring rich at a baseline, if you just want to have $1 million in the bank at you're 65 and you don't care about how you get there, and if it's $1 million or 1,300,000 or 800,000, whatever, if you just want to be generally in that range, you don't have to worry about this. But if you would prefer 1.5 million, 1.7 million, 1.8 million over, say, something like 1.2 million, this is important to understand. Because what emotion drives the market tells you exactly when you need to be investing more, or the opposite, when you need to be staying as far away from the stock market as possible, aside from your automated investments. At any given time, you should automatically be investing a steady amount of money that you can afford to actually build up over the long term. It can be the smallest amount, but to build on compound interest, you need to be consistently investing and letting the snowball build. Again, imagine you're pushing a snowball down the hill. You're packing on as much snow to that snowball as you can physically afford in order to grow that. Now, of course, you don't actually have to be, packing everything you own onto that snowball. I mean, some people do that, but you need to be packing enough on with the understanding that the bigger the snowball gets, the faster it will go, and the greater your wealth will grow. It actually sounds like a pretty good slogan. The faster the snowball goes, the bigger your wealth will grow. So again, at any given time when it comes to retiring wealthy, you need to actually be packing snow onto that snowball, regardless of what this says. That consistent baseline value is not going to go up or down. You're going to consistently invest that solid amount over a period of many, many years in order to retire wealthy. But you can retire much wealthier if you actually play this chart. by understanding what extreme fear and extreme greed means, you can actually retire much wealthier. So right now, as we can see by this, we're currently sitting in the neutral territory. At a point of 51 on the scale, you shouldn't be investing any less in the stock market or any more in the stock market when it comes to your overall broad investments, because this is the point where, hey, you know what? This is where you can just be steady and let the snowball go, and you don't have to put any more time or effort or thought into whether you should be investing more or less. But that's right now. What if, say, for example, this was in the fear or the extreme fear category? Now, I imagine in that case, you would be hearing a lot of fear mongering in the news. People saying, sell, sell, sell. Oh, the stock market's going down. It's never going to rebound. Things might not look good. You might think that it is a terrible time to invest. And you're not going to think that this is the best time to invest because you're saying, oh my gosh, everyone's posting about how much money they're losing. Why would anybody be investing at this time? But that's what happened back in 2022. In 2022, we were in a territory of fear to extreme fear, and people were not investing in the stock market. So things were at a relatively cheap value in comparison to when they were when you got to greed or extreme greed. Now, obviously, greed and extreme greed are the exact opposite. Greed and extreme greed is whether you should either be pulling your profits or understanding that you should just be not investing any more than your typical investments, because people are thinking, oh my gosh, we're all going to get rich. But the gravy train does not run forever. This is when things like COVID checks came out and people had excess income to spend. This is when cryptocurrency, meme coins, all of these things were booming because people had excess money to put into these, and everyone was thinking, oh my gosh, this next meme coin is going to get me rich, or oh, this stock's going to get me rich. No. You cannot be an emotional investor. It's all a gambler's fallacy. To truly retire wealthy off of a robo-investment platform, you need to put yourself above the emotion when it comes to it all. Look at things objectively. Look at the numbers. Ask yourself, is this meme coin really a safe or smart investment over the long term, or am I just getting caught up into the hype and news? And ideally, with a robo-investment platform, you wouldn't be making that decision yourself. You would have your automated investment set up. And say you came to this chart and it was in a state of extreme fear, well, you could go on there and go, okay, for the next 3 months, I'm going to invest $100 more in the stock market or $150 more in the stock market. You come back 3 months later and it goes, it's back into the greed territory. Okay, well, we'll tone it down back to my baseline. That is how you can retire wealthy, by making sure that you're not timing the market, understanding, when I should be buying the best stocks, but putting your time in the market. It's a classic phrase when it comes to saying, don't time the market, put your time in the market. Basically means that, invest over the long term consistently. Don't look at when the ticker is going up or down. Just look at this chart and understand that based on whatever sector we're in, you should be investing a little bit more money or a little bit less money. But sometimes people go overkill, and those emotional and irrational decisions lose them a lot of money when it comes to the long term. But algorithms, on the other hand, make decisions that aren't emotional. They make rational, calculated decisions based on a variety of technical factors that are going to be so much better than you. The algorithms remove the emotional bias that comes with investing and makes sure that whatever your investing goals are, the investment platform, the Robo-Advisors, can automatically rebalance your portfolio to fit your long-term goals. For me personally, I'm a young guy. If we have 2 market crashes, 3 market crashes before I turn 65, doesn't matter to me in terms of my investment growth for retirement. Does not matter to me, because what I'm doing is I'm putting my time in the market. I'm making it so that no matter what happens, if the stock portfolio goes up or it goes down, does not matter to me. I'm just consistently putting my time in. And because I've set my risk factors all to 10 on high growth stocks, I understand that over the short-term period, I could lose a couple $1,000s for a few months. By making it so that my investments are all in the higher growth category using these robo-advisors, I'm ensuring that through technical analysis done by these AI stock traders, I shouldn't say AI, it's algorithms. It all comes down to algorithms and just simple decision making. I can ensure that my wealth is going to be grown over the long term without any emotions getting in the way. And that my portfolio is always going to be rebalanced to assess the needs of my current investment strategies. Obviously, an investment portfolio with the intention of cashing out 10 years from now is going to look much different from what I have, where I'm not intending to cash out for 30 or 40 years. But the extra time that my money has to snowball faster and faster is going to allow me to actually retire wealthier because of a platform that removes those emotional biases. Now compare that to traditional investing, which is quite frankly more costly and less effective because the active investing that has to go into it, understanding everything, isn't algorithm driven. It's not driven by the data. And even though your portfolio managers say they try and be, not biased, every single human being is biased because you're going to be holding them accountable to make sure your stock portfolio performs well. Because even if your investment portfolio isn't intended to grow over, say, 30 or 40 years, maybe it's a shorter time frame, you are still going to be having those emotions driving your wealth growth as opposed to cold, hard logic, which is very hard to achieve. Robo-Advisors, on the other hand, focus on passive investing over the long term that maximizes your tax efficiency, making it so that your wealth grows in the most effective way possible over the long term, without any of the emotions included. Say a market crash actually happened. Say it was 2008. A robo-advisor would see that the prices of the stock are going down and would use a little something called dollar cost averaging, which just basically means exactly what I've been talking about, investing a fixed amount regardless of whether the stock goes up or down to ensure that you get the best average stock price to grow your portfolio over the long term. Now, obviously, when it comes to investing, you want to invest at the low point and sell at the high point. But by dollar cost averaging at a fixed value, you're ensuring that over the course of a long period of time, you are getting the best average price for the stocks that you're paying for. Robo-investors do that. Compare that to somebody like an emotional investor who would see all the stocks tanking and would panic sell. They would lose all of that value. They would kick and kill their snowball before it even has the chance to get rolling, before they can even allow their wealth to grow using compound interest. And if you're looking for an example, look no further than Bitcoin. Bitcoin, when it came to 2021, when people had tons of excess cash to go and spend, it shot up to the moon because people could invest in it because they thought it was going to be an asset that was worth a lot of money. When it came to something like a robo-investment platform, well, it doesn't exactly invest in crypto, but if you had a robo-advisor, it would understand the volatility of it and either stay away from Bitcoin or use dollar cost averaging, investing a consistent amount so that no matter what Bitcoin did, whether it went up or down, you were consistently getting the average and best price for purchasing parts of a Bitcoin. And although that may be a cryptocurrency, the idea here is the same. If Bitcoin goes up and you decide to, buy a bunch of it at the top and it goes down and you freak out and sell, well, now you've just bought high and sold low, as opposed to a robo-investor, which would have found somewhere in the middle to purchase at so that 10 years from now, when that investment has grown substantially, because just over time the value of that investment has grown, you would have gotten the best average price as opposed to spending a ton more money than you actually needed to. Don't believe me? Take a look for yourself. Here is the chart for Bitcoin over the last 5 years. Do you notice anything when it comes to the ups and downs? It swings. It swings a lot. It goes from very high to very low very fast. Notice anything? If we look at 2021 had some of the highest peaks for things like Bitcoin. This applied to the whole stock market. On the opposite side of this, of course, when it came to 2022, it crashed back down. Now, when would have been the best time to actually invest in the stock market? Well, if during the high of 2021, you looked at the fear to greed index, you would have understood that, hey, actually in a time of people being very greedy, well, you shouldn't be investing as much money because obviously people are going to be thinking that they're going to be buying at the perfect time when really they're buying at the high, when in reality you should just be holding on that fixed price that you're investing every month so you consistently can dollar cost average. Now, jump forward a year to 2022. If you went and looked at the fear to greed index and you saw that it was set to very fearful, well, you would know, okay, people aren't making as much money now, which means that it's a better time to invest more money into the robo-advisor so that it can rebalance my portfolio so that when it does get back to the very greedy side, I'm in a place to make a lot more money in the market. So you're ready to invest. Well, how simple is it? Actually, it's quite simple. I mean, many platforms have simple in their name because of how simple it is. You simply sign up for the platform or download an app. I'm not sponsored by anybody for this. There's no code you could use. Not that I would want you to use a code anyway, because I don't typically like to recommend financial products, because this isn't a financial YouTube channel. This is a tech YouTube channel. I like talking about more of the technical side of things with the way the market's going in the fintech space. I'm not as much focused on educating you on the finance side. Anyway, I digress. Go Google a couple, find the one that makes the most sense for you. In Canada, it's, Questrade or Wealthsimple. In the States, I think it's Robinhood is probably the number one, but I know there's a couple other ones down there. And the first thing they're going to do is complete what they like to call a risk assessment portfolio. Now that you've got the app downloaded, you're going to have to answer the most important questions of your life. The risk assessment questionnaire. To put it as simply as I possibly can, the risk assessment questionnaire basically says, when the market goes through a crash, are you someone who is going to sell everything and freak out? I think that was one of the questions when I was setting up my Wealthsimple account was, how would you react to a market crash? And for me, I answered them all the same. I said, I wouldn't react. I'm not an emotional investor. I don't look at whether it goes up or down. I just focus on investing for the long term, because that allows them to actually get you the best wealth for the long term. If you can consistently stick to this strategy and actually follow through on making sure you're not investing emotionally, but you're investing with logic, which again, all you need to do is invest more money when the market's a little bit down and less money when the market's up. And any other time, just consistently invest the same amount and you'll be retiring wealthy. Next thing you do after you complete that is create some accounts. I know there are some tax advantage accounts. There's things like Roth IRAs, TFSAs, RSPs, all these different types of accounts where you can actually write it off on your taxes, the amount that you're investing. If it's just for the long term, there's tons of government accounts. So I highly encourage you to do your research on what ones are available to you and fund your account. Hook up a bank account and put some money in. Now, to actually take full advantage of a robo-advisor, you're going to need to select the managed investment option so that you are actually getting them to do the investing for you and picking your portfolio and how it's dispersed. It's also going to ask you what your risk tolerance is. Now, usually it comes as like 1 to 10 or whatever method they actually have asking you. But basically the way it works is the higher your risk tolerance is, the more of a specific type of asset you can actually invest in. Now, if you're someone who's going to freak out if your stock portfolio goes down below 20% when things are bad, well, then you can actually have a lower risk tolerance. But understand that by doing that, you're going to be kneecapping yourself, because when the market swings back up, you're not going to have as big and as high of a swing. That's why when it comes to fintech, investing as soon as you physically can is the best way to do it. The younger you are, the more years you have to take advantage of compound investing. Like people say, if I had only invested in Bitcoin back in 2008, well, I'd be a millionaire by now. Well, jump forward 5 years. Well, okay, 2013 isn't as good of a time to invest in Bitcoin. It's starting to pick up a bit more steam. Jump forward 5 more years. 2018 isn't as big of a time. That's how it works for the entire stock market. The sooner you invest, the sooner you get access to compound interest, buying in on things before they increase in value 20, 30, 40 years ahead of time. And ideally, at the end of the road, when you get to the point where you have more than $1 million in your account or whatever amount you set out for yourself, when you actually have that, then you can switch your investment risk tolerance from 10 to 1, because making sure that your investments are going to be growing as much as they can is beneficial when you're young. But when you get to be a bit older and you actually need to hang on to that and you can't bear, a big downswing with as big of a portfolio as you may have, well, then that's the perfect time to set your risk tolerance a little bit lower so that you can actually take advantage of now not having as big of a dip during downturns. Because at that point, if you've got over $1 million in the bank, you don't really need that as big of an upturn as well. So what does this all come down to? Well, let me show you exactly what an investment portfolio would look like by just pulling up a simple calculator. But you know what? At the beginning of this video, I said something. I said anybody can do this. If you're young and you just started investing on a regular basis over the course of 20, 30, 40, 50 years, you can retire wealthy using Robo-Advisors. So I'll put my money where my mouth is. This is calculator.net, and this is a simple investment calculator. It can be used to calculate an investment plan and show you what your returns are. So let's start out simple. Let's say you have a starting amount of $0, and we're going to set our time frame at 40 years. Say, for example, you are 20 years old when you start investing, and you are 60 years old when you are finished investing. And we set the return rate at 6%. This would be what's called a conservative return. Ideally, we'd be shooting for something in the 8% or the 10% or even the 12% range. And you could get even higher than that the sooner you invest, depending on what assets you're investing in early. And so in this case, I'll go somewhere in the middle, we'll go 8%. And we say that it compounds annually here. And we'll say that at the beginning of each month, you invest $200. So that's how it goes. You start with nothing. You're doing it for 40 years. The return rate is about 8%. You're compounding annually, and every single month you put $200 in. It's like, just a little tax. It's the investment tax. It's the future rich tax. You hit calculate here, and we can see that at the end of the 40 years, you would have $648,000 in your account from an initial investment of only $96,000. Over the period of 20 years, you only ever put in $96,000. But through the power and magic of compound interest, and through removing the emotional side of things through Wealthsimple or Questrade or Robinhood or Robo-Advisors, you've turned that into $648,000. Now, let's increase that to be a little bit higher. Obviously, if the return rate was a bit higher, we move that up to 10%. We can see that's now $1.1 million. You go up 2% in your return rate and you get to $1.1 million. Or we can move it back down to a return rate of 8% and double the contribution per month. And again, $1.3 million. This is assuming you're only ever investing $400 a month from the time you turn 20 to the time you turn 60. You don't ever increase your investments. You don't ever decrease your investments. You're just 400 across the board. That is how the power of compound interest works. Because you invest $400 over a period of 40 years at a return rate of 8%, which again, is pretty low compared to what people are speculating things are going to be, especially over such a long time period. You can end up with over $1 million in the bank with only an investment of $192,000, $96,000, $100,000, whatever it may be. And then if you get to something like a higher return rate, as high as 12% or even greater than that, you could have $3 million, $4 million in the bank account as you retire. And that, my friends, is the no BS guide on how to retire wealthy using Robo-Advisors. It's dead simple if you can get out of your own way. Just set your price targets, pull up the calculator, understand how much you're investing every single month, go away for 20, 30, 40 years, and you'll come back with a couple million in the bank. Thank you so much for watching. As always, my name is Josh Mountain. I hope you enjoyed this video. It's a little bit out of the territory of what I normally do for technology on this channel, but financial technology is still technology all the same. So I always thank you for watching, and I hope to see you in the next one. See ya.